Hello everyone, this is ACC Amit Kumar, and in the series of discussing past exam papers, I'll be discussing with you today June 2018 question paper. So we'll be discussing the first question based on consolidated income statement, and we'll share the insights on how to perform an income statement question. So let's have a look at it. So here's the question for consolidation question number 1. So the first thing to be done in any question is read the requirement and then only proceed to read the remaining content of the question. So when we read the requirement, we get to know that we need to prepare the consolidated statement of profit and loss and other comprehensive income of Alpha for the year ended 31st March 2018. So we need to prepare consolidated statement of profit or loss and other comprehensive income for the period ended 31st March 2018. We'll consider the tax effects and all the workings will be done to nearest 1000. So let's have a look. So we are given the income statement of profit or loss and other comprehensive income is given to us of Alpha, Beta and Gamma. Alpha holds investment in a number of entities including Beta and Gamma. The statement of profit or loss and other comprehensive income and summarized statement of changes in equity of 3 entities is given to us. So the reporting date information and for the period is given to us of Alpha, Beta and Gamma. The other comprehensive income which will not be reclassified to P&L, revenue, cost of sales, and revenue is covering in note number 4. Cost of sales, there are details in note number 1, 2 and 4. Administration expenses in note number 5 and 7. So we'll have a look at it. Then we have summarized changes in equity, statement of change in equity. The balance is given to us of 1st April 2017 of Alpha is 420,000, Beta is 280,000 and Gamma is 180,000. Alpha's investment in Beta is acquired on 1st April 2011. Alpha acquired 75 million shares out of 100 million equity shares of Beta. So we have a note on investment in Beta, we have a note on investment in Gamma, that when did we acquire them, what is the goodwill position. So these two information are given to us for knowing the goodwill. If there is an impairment of goodwill, we'll be testing it for impairment. Alpha's investment in Gamma is provided to us. So again, if there is any impairment of goodwill, we'll need this information. But they say that there is no impairment of goodwill on acquisition of Gamma. Note number 3 is for disposal of shares in Gamma. So this information provided to us in note number 2 is related to Gamma on the date of acquisition. It is disposed of. So we'll need information from the date of acquisition till the date of disposal. So this has been disposed of on 30th November. Fourth note is regarding intra-group trading between Beta and Gamma. Then there is a note on leased asset and investment income, which is shown in Alpha's statement of P&L, represents dividend received from its subsidiary entities. So there is dividend received from subsidiary entities, plus also there is a portfolio which is being measured at fair value. So we'll have a look at it. And then we have a retirement benefit plan. So this is the, just have a glance at the question so that we know what are the notes we need to cater to and which all statements we need to deal with. So the first thing in any question, whether it is balance sheet or income statement, the first thing to be done is define the group structure so that we are aware what we are going to do, what all workings we need to do. So I always recommend that now we need to prepare consolidated statement of profit or loss and other comprehensive income for the year ended 30th September 2018. It is 31st March 2018. We need to prepare income statement for the year ended 31st March 2018. 31st March 2018. So in your CB examination pattern, simply copy paste the entire income statement so that we know what is to be done. So we need to add up the revenue of alpha, beta and gamma. We need to add up the cost of sales. So the working notes will be dependent on what is the total amount of revenue, what is the total amount of cost of sales. We need to deal with if there is any impairment loss. So in the income statement, the major workings are any intragroup transaction, unrealized profit, calculation of impairment of goodwill if there is any, and in this case, in this question, there is a disposal of a subsidiary. So we'll need to see the profit or loss on disposal of a subsidiary. If there is any investment income, that will be replaced because we are adding up line by line consolidation. So we'll add up all the revenue and expenses of parent plus subsidiary. We'll be adding up line by line. Then we'll be dividing it between parent and NCI. What is belonging to parent, what is belonging to NCI. So you can leave some space for revenue, cost of sales. Then we'll have gross profit, distribution costs. So there are some free marks available as well. Administration expenses, administrative expenses, investment income if there is any, we can take a note of it. We'll see to it whether we'll be including any investment income or not, or is it all belonging to the dividend received. So we'll not be including any line item. For the time being, include it, remove it if there is no income from any other sources. Finance costs. In it, as I said, profit or loss on disposal of gamma, since we know gamma has been disposed of. If there is any impairment of goodwill, that will also be forming part of the impairment of goodwill. The question may say that include it as part of cost of sales. So we'll be including it as part of the working of cost of sales. If nothing is mentioned, then we can include it separately. So we'll see to it. For the time being, leave space. Finance cost, profit or loss on disposal. Then there is profit before tax. Income tax expense. And profit for the year. Then there is other comprehensive income. In other comprehensive income, we have remeasurement of gain or loss on defined benefit. Pension plan, there is nothing done here, so we'll be including something. So we'll use the same line item. There may be some amount to be included, remeasurement. When we deal with note number 7, remeasurement, gain or loss on defined benefit. So we'll include other comprehensive income, remeasurement, gain or loss on defined benefit, retirement pension plan as included in the income statement. So the line items which are there in the income statement that will exist, there may be some which may disappear, like investment income may disappear, but there will be more which will be included, like impairment of goodwill, profit or loss on disposal. We'll be dealing with unrealized profit either directly as part of inclusion in cost of sales, or we'll be deducting it directly from the gross profit. Intragroup transactions we can remove from revenue and cost of sales in the workings. So that is what is to be done, and we'll get the total comprehensive income. After this is done, we'll get total comprehensive income. So we'll be dividing the total profit for the year between parent and NCI. We'll be dividing the total comprehensive income between parent and NCI. This is the last thing to be done by us. We'll be dividing the entire question into workings. The first working will be related to revenue. Second working will be related to cost of sales. Third working will be related to the goodwill calculation so that we get to know how much is the impairment. Fourth working can be related to profit or loss on disposal. So these are the major workings we need to do. So if you look at the revenue, it will be of parent alpha plus beta plus gamma. But before it, like in any question, I would recommend, like my personal suggestion is that whether you do balance sheet question or whether you do income statement question, the first thing to be done is define the group structure, because that makes our life easier. Define the group structure. Alpha is the parent, beta is subsidiary, gamma is also a subsidiary. What is the date of acquisition of beta? 1st April 2011. 1st April 2011. Alpha is valuing NCI on proportionate share of net assets. No impairment of goodwill on acquisition of beta have been necessary in the consolidated financial statement of Alpha up to and including 31st March 2017. That means this exists till 31st March 17. And beta is a cash generating unit. The annual impairment review conducted on 31st March 18 indicate that recoverable amount of net assets including goodwill of beta at that date were 350 million. So beta exists as of 31st March 2018, but it is requesting us to do an impairment testing. So we'll be doing it. So date of balance sheet in case of beta is 31st March 2018. So we need to know these dates so that we know whether it exists or not. In case of gamma, date of acquisition is 1st April 2012. 1st April 2012. On 1st April 2012, the carrying amounts were this. Alpha used the fair value method, the fair value of equity share in gamma on 1st April. No impairment of goodwill on acquisition of gamma has been necessary in the consolidated financial statements of Alpha up to and including 31st March 2017. So it was existing till 31st March 17. What is the status of 31st March 18? On 30th November, now it is written clearly, disposal of shares. On 30th November 2017, Alpha disposed of its entire shareholding in gamma for a cash consideration of 196 million. Income tax payable is 5 million. On 30th November, Alpha credited the disposal proceeds to suspense account and has not made any entries. You can assume that the profits of gamma for the year ended 31st March accrued evenly. So the date of disposal in case of gamma is 30th November 2017. And the profits are accruing evenly. If profits are accruing evenly, then in the current year, which began on 1st April 2017, it will accrue for how many months? April, May, June, July, August, September, October, November. 8 months of profit will accrue evenly. Apart from this, let's have a look at other investments so that there is no confusion hereafter. Intragroup trading, that is between beta and gamma, we have noted about them. There is a leased asset which is leased with a third party. There is investment income which is shown as Alpha's statement of P&L, represents dividend received from its subsidiary entities and also income arising from a portfolio of loan investments. This portfolio is classified by Alpha as fair value through other comprehensive income. The gain on remeasurement of the portfolio to fair value at 31st March 2018 was 5600. The gain has not yet been recognized in the financial statements of Alpha. So there is a dividend income received from its subsidiary entities, and also income arising from portfolio of loan investment. Now the remeasurement of this is recognized as part of other comprehensive income. So we can include it as part of gain on remeasurement of financial assets. We'll be including a gain of 5,600 as part of the financial statements. In other comprehensive income. So record it immediately. Apart from this, we can give a note, investment income. Investment income presented in the income statement is 32,000. And this is saying that this is dividend declared from Beta and Gamma. Beta has declared a dividend of 32,000. Now Gamma has declared a dividend on 31st December 2017. If Gamma has declared a dividend on 31st December 2017 and they were disposed of on 30th November 2017, 30th November 2017, did Alpha receive anything from this amount? That means nothing received from the dividend paid by Gamma. Dividend paid by Beta 32,000 is the dividend paid by Beta. But for that we should know how much belongs to us. So in the group structure, next thing was, what is the share of each entity? Beta acquired 75 million shares of 100 million equity shares of Beta and gained control. 75 million out of 100 million represents 75%. NCI, non-controlling interest, which we call it NCI, NCI represents 25%. In case of Gamma share, 40 million out of 50 million shares of Gamma. 40 million out of 50 million, which means 80%. Non-controlling interest is 20%. So if there is an investment income received in which dividend paid by Beta 32,000, so dividend received by Alpha from Beta, dividend received by Alpha from Beta is equal to 75% of 32,000. This will be eliminated on consolidation. So remaining investment income will be presented as part of the investment income because this is income received from other investments. Remaining to be presented as part of income statement. 32,000 minus 24,000. 8,000 will be presented as part of income statement. So investment income, you can give a note number 4 and include 8,000 as part of investment income to be presented in the consolidated statement of P&L and other comprehensive income as of 31st March 2018. And gain on remeasurement of financial assets, which is measured at fair value through OCI. Measured at fair value through OCI need to be included as part of other comprehensive income. So these are the two adjustments from this note which we have already dealt with. In case of revenue, we have Alpha's revenue, that is 628,000. Alpha's revenue 628,000. Beta's revenue 560,000. Gamma's revenue is 450,000, so 8 by 12 of 4,50,000. 8 by 12 of 4,50,000 will be only included. In it, we deal with intra-group trading. Now, there is a para for intra-group trading. Alpha supplies a component which has been used by both beta and gamma. Alpha applies a markup of 1/3 to the cost of these supplies when computing the sales price. Details of sales of the component to beta and gamma in the current accounting period and the holdings of inventory of component by two entities are as follows. Sales of the component by Alpha to beta and gamma before 30th November 2017, that is before the disposal of gamma, is equal to 25,000 plus 15,000 less intra-group transaction. Intra-group transaction is to be eliminated from both the sides. How much is intra-group transaction? The sales by Alpha to beta and gamma before 30th November 2017 are worth 25,000 plus 15,000, that is 40,000. 25,000 plus 15,000 minus 40,000 is to be eliminated from both sides. So that's the amount of revenue to be recognized is equivalent to 1,448,000 of revenue to be recognized as part of the financials. Next is cost of sales. The cost of sales will be dealt with in the same manner like we did for revenue. Cost of sales of Alpha is 378,000. Beta it is 335,000. Gamma it is 8 by 12 of 270,000 is gamma's cost of sales. Equal to 8 by 12 of 270,000. Intra-group transaction, same amount will be deducted from both the sides. But apart from this, there will be unrealized profit treatment as well. We add any unrealized profit on sale of goods to treat the unrealized profit. So there are two choices for treatment of unrealized profit. One choice is you can reduce it directly from the gross profit on the face of the income statement. The other choice is to increase the cost of sales. So I am choosing to increase the cost of sales for dealing with unrealized profit on sale of goods. So how much is unrealized profit on sale of goods? In the intra-group trading, inventory of component on 31st March 2017 was 4,804,000 of beta and gamma. inventory of component on 31st March 2018 in Beta's books was 6400. So this is the closing inventory on 31st March 2018, and we have analyzed profit only in the closing inventory, which we add up. If there is an opening inventory analyzed profit, that will deduct. So analyzed profit on sale of goods in the closing inventory will be adding up. But if there is any analyzed profit on sale of goods in the opening inventory, that will be deducting. Less unrealized profit on sale of goods opening inventory. So how much is it? Alpha supplies components at a markup of 1/3 to the cost of these slices. If markup is 1/3, then margin is 1/4. 1/4 of the selling price is the margin. So if 6400 is the price, then 6400 into 1/4 is analyzed profit. So 1600 will get added as part of the cost of sales. Apart from this, the inventory component on 31st March 2017 of Beta and Gamma is 4800 plus 4000, which has unrealized profit of 1/4 of the same amount. 1/4 of 4800 plus 4000, which turns out to be 8800. So less 1/4 multiplied with 8800 is the unrealized profit to be deducted from the cost of sales. Apart from this, we need to scan whether the question will tell us whether we need to charge impairment, depreciation as part of cost of sales, or it will be treated separately. So we can scan through the words like depreciation. If you read this note, there is information about the investment, there is information about the share of Alpha. Net assets had a fair value of 200 million. The proportion of net assets need to be presented at non-controlling interest. Any impairment of goodwill should be charged to cost of sales. So if impairment of goodwill is to be charged to cost of sales, and if there is any impairment, now they are giving us information, they are giving us a full note, also telling us that NCI is valued on proportionate share of net assets, which gives us an indication that there must be an impairment of goodwill. And they've given us the recoverable amount at 350 million, which is giving an indication that there must be an impairment of goodwill. Otherwise, all this information is unnecessary. This is not needed. So we should be prepared for write impairment of goodwill here. If there is any, we'll include it. If there is not, we'll ignore it. For the moment, write it and keep it blank and highlight it so that you remember it. Impairment of goodwill. Next is all depreciation of property, plant and equipment is charged to cost of sales. Now if there is any depreciation to be charged, we'll remember to charge depreciation relating to property, plant and equipment, which is relating to Alpha's depreciation must have been charged, but we need to worry about any Beta or Gamma's depreciation which is not being charged. Gamma has been disposed of, so nothing will come. And if there was any, that must have been charged by the end of the year. So if there is any fair value adjustment which still remains as part of the cost of the balance sheet, we need to take care of the depreciation relating to it. So let's have a look at for impairment of goodwill. And one more thing we need is profit or loss on disposal of Gamma. These are the two important workings. Now for profit or loss on disposal of Gamma, we'll be needing. So working note number 5 will be calculation of goodwill for beta so that we can test it for impairment, and we'll need working note number 6, profit or loss on disposal of gamma. So profit on or loss on disposal of gamma will require 3 things from us. We'll need the net assets of gamma on date of disposal. We'll need the value of NCI on date of disposal, and we'll need the goodwill at the time of acquisition of gamma, and if there is any impairment thereon. That impairment has been ruled out, that no impairment of goodwill on acquisition of gamma have been necessary in the consolidated financial statements of Alpha up to and including 31st March 17. And before 31st March 2018, this has been disposed of. So we'll need the goodwill calculation on the date of acquisition, we'll need NCI valuation on the date of disposal, and we will need net assets of gamma on the date of disposal. These 3 things will help us into calculating the profit or loss on disposal. So from it, what we'll do, we'll compare the sales proceeds on disposal of gamma which is equivalent to 196,000. Income tax payable on this disposal is expected to be 5 million. Now that income tax will be treated separately. Working note number 7, income tax note relating to it. We can include the income tax of in similar fashion. Alpha, beta and gamma 38, 29, 21,000. 38,000, 29,000 and 8 by 12 of 21,000. That is 14,000 is the income statement of gamma, and in this income tax payable on disposal of gamma. $5,000 gets added here. On 30th November 2017, Alpha credited disposal proceeds to suspense account and has not made any entries. You can assume that the profits of gamma for the year ending 31st March 2018 accrued evenly. Let's work backwards now to calculate the goodwill. For calculating goodwill, we'll need the cost of investment, calculation of goodwill of beta. We'll need the net assets on the date of acquisition. So these shares were acquired purchase consideration. Alpha acquired equity shares of beta by issuing 1 new share in Alpha for every 2 shares acquired in beta. So 75,000 shares acquired. For every 2 share acquired, 1 new share issued, and the price of each share is 4.40. So the payment is equal to 75,000 divided by 2 into 4.40. 165,000 is the purchase consideration. Then we'll need value of NCI on date of acquisition. It is on the basis of proportionate share of net assets. The net assets of beta on this date are given. Net assets of beta on date of acquisition is equal to 200,000, out of which 25% of it belongs to 25% of 200,000 belongs to the value of NCI. No impairment of goodwill on that date, and all of which has been disposed of or settled by 31st March 2017. So there is no need to charge any depreciation in the current year because everything has been disposed of, settled till 31st March 17. There is nothing related to it as far as fair value adjustments were concerned. So the goodwill relating to it on the date of acquisition is equal to the goodwill relating to it on the date of acquisition is 165,000 plus 50,000 minus 200,000 is 15,000 in the goodwill. It says that beta is a single cash generating unit. On 31st March 2018, the annual impairment review indicated that recoverable amount of net assets including goodwill of beta at that date were 350 million. Any impairment of goodwill should be charged to cost of sales. So recoverable amount including goodwill is 350 million. So what is the net assets position as of 31st March 2018? We'll get to know from the profit for the year. How much is the profit for the year? The balance on 1st April 2017 is 280,000. On when the day it was acquired it was 200,000. The comprehensive income for the year is 86,000. There is a dividend paid of 32,000. The balance on 31st March 2018 is 334,000. So how much is post acquisition profits? And if I gross up this goodwill, grossing up of goodwill, this turns out to be, this goodwill is representing 75% into 100 will be 15,000 divided by 75 into 100 will be 20,000. So if I calculate the net assets of beta, net assets of subsidiary beta on 31st March 2018, they turn out to be equivalent to 334,000. The recoverable amount of net assets including goodwill is equal to 350,000. That means there is an impairment of goodwill of 20,000 is the goodwill plus net assets of subsidiary on 31st March 2018 is 334,000 minus recoverable amount on this date is 350,000. That means impairment of goodwill is 4,000, which is to be charged as part of cost of sales. So as I said, this information, this note number 1 is given to us only for the purpose of calculating impairment of goodwill, is everything remaining constant, and this information is also given to us for calculating the value of NCI, which we did by applying the percentage and calculated goodwill and also tested for impairment of goodwill. So this impairment of goodwill 4,000 will be included as part of cost of sales. 4,000 will be included as part of cost of sales. So one part is over, good impairment of goodwill is done. Now we need net assets of Gamma on the date of disposal. For that, sales proceeds on date of disposal is provided to us. We need net assets of Gamma on the date of disposal. How do we get to know the net assets of Gamma on the date of disposal? Through this information. So we can do these calculations separately within the notes and bring these 3 calculations. Now within this working note number 6, we can calculate the net assets. So the first thing we need is goodwill calculation. For that we'll need purchase consideration, value of NCI on date of acquisition, and fair value of net assets of subsidiary. The fair value of net assets of subsidiary. On 1st April 2012, Alpha acquired 40 million out of the 50 million shares. Alpha has paid 145 million in cash for the equity shares. So the purchase consideration is 145,000. Value of NCI on the date of acquisition. Alpha used the fair value method for measuring NCI when recognizing the goodwill on acquisition. The fair value of equity shares in Gamma on 1st April 2012 was 3.50. This can be used to measure the fair value. On 1st April, no impairment of goodwill on acquisition of Gamma have been necessary in the consolidated financial statements of 31st March. So this information of 3.50 we can use for valuation of NCI, that is 10,000 into 3.50. 3.50, 35,000 is the value of NCI. Now we need fair value of net assets of subsidiary. Now when we look at the fair value of net assets, the carrying amount of net assets of Gamma in its individual financial statements were 150 million and their fair values were 170 million. The differences were caused by property whose fair value exceeded the carrying amount by 12 million. 8.4 million of this difference refer to the depreciable component of this property. The estimated useful life of the depreciable component of the property at 1st April 2012 was 8 years. Plant and equipment whose fair value exceeded the carrying amount by 8 million. The estimated remaining life of the plant and equipment was 4 years. Now, out of the 2 items which were fair valued, plant and equipment is fully consumed over a period of 4 years. There is no component relating to it. There is a depreciable component relating to property which had a life of 8 years and it was acquired on 1st April 2012, and we disposed of this subsidiary Gamma on 30th November 2017. So we need to charge depreciation till this date. So the depreciation of 8 months is yet to be charged in the current year, which has not been charged. And in the previous years, the fair value adjustment included 170 million, which also has been depreciated over a period of till 31st March 2017. It has been 5 years now, 13, 14, 15, 16, 17, 5 years depreciation has been charge. So it is supposed to be at a reduced amount now, and the current year depreciation to be charged is for 8 months. So the fair value of net assets on the date of acquisition of subsidiary is equal to 170,000. So the goodwill so calculated is equivalent to 145 plus 35,000 minus 170,000. So the goodwill is 10,000. So goodwill at the time of acquisition of Gamma is equal to 10,000. Now we need value of NCI on the date of disposal. For knowing the value of NCI on the date of disposal, we know the fair value of net asset subsidiary on the date of acquisition. This has increased to balance on 1st April 2017. It is 180,000 and the current year profit is 63,000. So that means the net assets have increased from 170 to 180, and this year this has increased by 63,000, in which it is accrued evenly. Only 8 by 12 belongs to the current year, and there has been a depreciation for 8 months for plant and equipment to be charged in it. So now we need to calculate the net assets on date of disposal. So net assets on 31st March 2017 or 1st April 2017 is one and the same thing. Net assets on 1st April 2017 is 180,000. Profit till date of disposal, that is 8 by 12 of 63,000. $42,000 is the profit till date of disposal. Fair value adjustments. The fair value adjustment is relating to property which was fair valued by 12 million, out of which 8.4 million was depreciable component, and it had a life of 8 years. 8 years means 96 months life. It has been depreciated till the date of disposal by 68 months. So how much is remaining? 8400 divided by 96 into 68 months of depreciation has been charged. How much is remaining? 28 months of property is pending. 8400 divided by 96 into 28 is pending. 2450 worth of net assets is pending as far as depreciable component is concerned. $2450 worth of net assets is pending among the depreciable component. In the same, non-depreciable component is the property which exceeded by 12,000. 8.4 million was depreciable. Out of the depreciable component, it has been depreciated by 68 months. So there was a component relating to 28 months which is still pending, which can still give us economic benefits for the remaining 28 months, or whosoever has purchased this Gamma entity will be able to get benefited out of 28 months of this property. Non-depreciable component of the property, is equal to 12,000 minus 8.4 3600 is non-depreciable component. So the total net assets of the entity is 228,050. So this is the net assets of Gamma on the date of disposal. Net assets of Gamma on the date of disposal. Now we need value of NCI on date of disposal. Value of NCI on date of disposal value of NCI on date of acquisition is equal to 35,000 plus share of profit till date of disposal, share of profit till date of disposal this is the net assets position 228 on date of disposal. So share of profit from the date of disposal will be 228,050 minus fair value of net assets on date of acquisition was 170,000. In this, the percentage of NCI equal to 20%. That means 228,050 minus 170,000 is equal to 58050. 58050, in which there is a share of 20% of 58050 is the value of NCI on the date of disposal. So total turns out to be equivalent to 35,000 plus 11,610 is the value of NCI on the date of disposal. So this was the third thing needed by us, that what is the value of NCI on date of disposal. 46,610. So how much is profit or loss on disposal? 196 plus value of NCI minus NCI on the date of disposal minus goodwill. The value of NCI on the date of disposal gets added to the sales proceeds representing 100% value, which is compared with the disposal of Gamma, which is representing 80%, and goodwill of Gamma, which is representing parent's goodwill. So we get profit or loss on disposal of Gamma. This will be included as part of the income statement. Profit or loss on disposal of Gamma is equivalent to 4560. This will be referring to working note number 6. Working note number 6 will give us profit or loss on disposal of Gamma. In working note number 3, the impairment of goodwill, we grossed up the goodwill here. We grossed up the goodwill, making it 100%. So this impairment of goodwill is representing 100%. How much to be charged to group retained earnings? If we were doing it on the income statement or income statement of parent, it will be to the extent of share. that is 75%. So impairment to be charged is actually 75% of 4,000. By mistake written the entire 4,000 here. So the impairment of goodwill is actually minus 3,000. Is the impairment of goodwill to be included? Do not commit this mistake. So whenever we gross up the goodwill is calculated is belonging to parent plus NCI after grossing up. So when we are charging the goodwill is belonging to parent only. So only parent's goodwill gets impaired. If parent's goodwill gets impaired, we'll only give a share belonging to the parent only. That is 3,000. So we have dealt with working note number 1. We have dealt with working note number 2, 3, 4, 6. Let's deal with leased asset. Working note number 8 deals with leased asset. Alpha began to lease a property. The lease term was 5 years. The lease does not transfer ownership of the property to Alpha at the end of the lease term. Alpha does not have an option to purchase the property at the end of the lease term. So the date of lease first April 2017, that is beginning of this year. Alpha does not have the option to purchase the property at the end of the lease term. The lease term was 5 years. Useful life of the property was 20 years. Rentals payable by Alpha for the use of property was 1 million per annum, payable annually in arrears. Alpha incurred direct costs of 100,000 in arranging the lease. Direct cost 100,000. Annual rentals 1 million. In the year ended 31st March 2018, Alpha charged both the annual rental of 1 million and direct cost of 100,000 to administrative expenses. So we'll open up one more note, working note number 9, administrative expenses. The rate of interest implicit in the lease is 7%. The present value of $1 payable in 5 years annually in arrears at a discount rate of 7% is 4.10. All depreciation should be charged to cost of sales. So when the life is 20 years, it is for 1/4 of the period. So in previous accounting, we would have recorded it as part of operating leases. The accounting would have been fine that we are charging it as part of operating lease rentals, incurred direct cost. But the accounting of leases is now being done under IFRS 16, which wants us to recognize it as a right of use asset. Now, right of use asset is consisting of rights of use asset is consisting of direct costs plus present value of all lease payments, as well as lease liabilities to be recorded, which is also present value of all lease payments. So when the cash flow is constant, that is 1 million per annum, and it is going to be for a period of 5 years, the annuity table is given to us at the rate of 4.10, and if it is 1 million, The annuity table says that the present value of all these payments today is 1 million into 4.10. That is 4100 in rounding to 1000. Direct cost is 100,000. Total turns out to be, we'll take it out, it will turn out to be 4100 and 100. Total right of use asset equals to 100 plus 4100, that is 4200. The present value of all these payments is 4100. In the income statement, there will be unwinding of discount. In the income statement, there will be unwinding of discount, which will be forming part of finance cost. Working note number 10, finance cost. Administrative expenses, there is an expense of 1 million and 100,000 to administrative expenses, which need to be reversed because that is added as part of right of use asset. There will be a depreciation on right of use asset, which will also be supposed to be charged to cost of sales. And depreciation will be over a period of 5 years. Depreciation will be equivalent to 4200 divided by 5 is equal to 4200 divided by 5. There is a depreciation charge of 840 to be charged in cost of sales. Depreciation on rights of use asset is equal to 840. Working note number 8. This is an expense added to the cost of sales. In administrative expenses, we have 64, 56, 51. 64,000, 56,000 and 8 by 12 of 51,000. There is reversal of this expense expense relating to leases. It equals to minus 1100, reversal of expense relating to leases, which was relating to leased asset of 1100. Now there is finance cost 30, 2018. $30,000, 20,000 and 18,000. Unwinding of discount on leases is equal to 7% of 4100. 7% of 4100 is the unwinding of discount on leases, that is 287, is to be added as part of the finance cost. This is how we have to deal with leases component. All depreciation is charged to cost of sales. We have already charged 840 as part of cost of sales depreciation on right of use asset, 840. Then there was retirement benefit plans. We'll have a look at retirement benefit plan calculations. Working note number 11. Retirement benefit pension plans. There is net assets given and it is net defined benefit obligation. So net defined benefit obligation is 2500 as of 31st March 2017. So opening balance is given to us of 31st March 2017, that is 2500, and it is given as liability. Net defined benefit obligation. Obligation means there is a liability. The net defined benefit obligation on closing balance on 31st March 2018. Closing balance on 31st March 2018, that is net defined benefit obligation on this date, is equal to 4000. Current service cost for the year is 5 million. Current service cost for the year is 5000. Contributions paid by Alpha into the plan during the year ended 31st March 2018 were 4800 million. Contributions to the plan reduces the net liability, 4800. Benefit paid out by the plan to retired members during the year ended 31st March 18 were 2.5 million. That's 2.5 million is reduced from both sides. The difference is unrecognized actuarial gain or loss. Apart from this, on 1st April, the market yield on high quality corporate bonds was 5% per annum. So in the year ended 31st March 2018, Alpha charged the contribution paid to administrative expenses but made no other accounting entries. The post-employment plans for the employees of Beta and Gamma are defined contribution plans. The relevant accounting entries in the financial statements of both Beta and Gamma are correct. So the current service cost, which is charged as 5000, contribution to the plan is 4800. In the administrative expenses, what is actually done is reversal of payment of contribution, that is minus 4800, and current service cost for the period. Current service cost for the period is to be charged as 5000. So administration expenses is supposed to be 153,100. The finance cost net defined benefit interest expense is equal to 5% of 2500, that is 125. when we total, the total turned out to be 2825, but in reality the liability is 4000. So there's a difference of 4000 minus 2825. 1175 is the unrecognized actual gain or loss. 1175 is the unrecognized actual gain or loss to be recognized as part of other comprehensive income. 125 is the net defined benefit expense, which is P net defined benefit expense turned out to be equal to 125. Total interest expense is 62412. Total administration expenses is 153100. And unrecognized actual gains and loss 1175 is to be recognized as part of other comprehensive income 1175. Remeasurement gain or loss on defined benefit pension plan. Remeasurement loss minus 1175 is the retirement loss on defined benefit retirement pension plan, calculated in note number 11. So we present now revenue is equal to 1448,000. It is representing working note number 2. We simply write working note number 2 in front of it. Cost of sales, working note number 3, alpha plus beta plus gamma minus intragroup transaction of 40,000, treating unrealized profit of 1600, adding unrealized profit on opening inventory is minus 2200. Then there is impairment of goodwill of beta, depreciation of right of use asset, apart from it there is one component which is pending, is depreciation of on property for 8 months of gamma. So depreciation on property which we calculated in the depreciable component, in the current year the depreciation which is supposed to be charged is, out of the total depreciation charged here, 8400 divided by 96, we need depreciation of 8 months, that is equal to 700 depreciation charge for the year, which has not been charged as part of current income statement relating to gamma. While calculating the net assets of gamma on date of disposal, we have included this depreciation as part of our adjustments, but we did not include it as part of current year income statement. So depreciation on property of gamma is 700. When I total the cost of sales, it represents 378,000 of alpha, beta, 180,000 of gamma. Intra-group transaction needs to be eliminated from both revenue and cost of sales. So we eliminated 40,000. Unrealized profit on sale of goods of closing inventory gets added up. So this is an expense, and expense gets added up. The unrealized profit on opening inventory will reduce our cost of sales. The impairment of goodwill is an expense. Expense needs to be added up. That is 3,000. It needs to be added up. Depreciation of right of use asset is an expense, added 840. Depreciation of property for 8 months of gamma added at 700. The total cost of sales is 856,940. So total cost of sales to be included is 856,940. So the gross profit is equal to 14480 minus 856,940. The distribution costs are 38, 34, 27,000. 34,000 plus 8 by 12 of 27,000. 8 by 12 of 27,000 is 18,000. 18,000 plus 34 plus 38. Plus 34,000 plus 38,000. 90,000 is the total distribution cost. Thereafter, administration expenses is working note number 9153100. Working note number 9, 1,53,100. Investment income we have already included at 8,000. Finance cost is working note number 10, equivalent to 62,412. Profit on disposal of Gamma already included. At 4560. Profit before tax is equivalent to gross profit minus distribution cost minus administration cost plus investment income minus finance cost plus profit or loss on disposal. This is the profit before tax. Income tax expense for the year, we have a note for it, that is 86,000 is the income tax expense for the year. Note number 7. Note number 7 is income tax expense for the year. We have profit for the year, that is 298,108 minus 86,000. Total comprehensive income for the year is equal to this minus 1175 plus 5,600, 216,533 is the total comprehensive income for the year. So how much is the profit attributable to parent and how much is profit attributable to NCI? We'll pick it from the profit of Gamma, that is 63,000, out of which in this 700 of depreciation has not been charged till date. So 63,000 minus 700 . 700 is 8 months depreciation. So it will be actually 63,000 into 8 by 12 minus 700 depreciation, which will give us the total in which NCI has a share of only 20%. So there are people who commit this mistake here, that when they are calculating the 63,000, they deduct 700 directly from the 63,000. The 63,000 is the total profit for the year. 700 is only 8 months depreciation. When we make it 63 into 8 by 12, we get the profit for 8 months. Out of the profit for 8 months, we can deduct 700 depreciation. Out of the profit of 8 months, we can deduct 700 depreciation in which NCI has a share of 20%. So 63,000 into 8 by 12 is equal to profit for the year. We calculated 63,000 into 8 by 12 is 42,000. 42,000 minus 700, it is equal to 41,300 into 20%, which turns out to be equivalent to 41,300 into 20%, 8260 is the profit belonging to NCI of gamma. How much is the profit belonging to NCI of beta? It is equivalent to 25% of 86,000. 25% of 86,000. It is equal to 21,500. So the profit belonging to the parent is equal to 212,108 minus 21,500 minus 8260 is the profit belonging to the parent. The same when I do it for NCI valuation. So this is the profit attributable to parent and the profit attributable to NCI. If I divide the same into what is the profit attributable to parent, do the same calculation. The valuation of NCI will be same as done here. The only difference will be now the total will be from total comprehensive income, that is 216,533 minus 21,500 minus 8260. 186,773 is the total profit attributable to parent. So the total comprehensive income for the year turns out to be 186,773 plus 21,500 plus 8260 is the total comprehensive income for the year belonging to parent as well as NCI. This is how we'll deal with consolidated statement of profit and loss and other comprehensive income for the year ended 31st March 2018. We'll be presenting revenue, gross profit, all our workings. We'll divide the profit attributable between parent and NCI, total comprehensive income between parent and NCI. We'll do all the working notes. And if there's still any concerns, please let me know. So this is all for calculation of question 1 of June 2018 Diploma in IFRS exam standard question. All the best wishes. Thanks for your valuable time. See you again in the next practice session. Thank you.